Have you ever been on the road, minding your business, and suddenly you end up behind a truck so expensive it looks like it belongs in a showroom, not traffic? I'm talking about the kind of vehicle that shines like a mirror, packed with features you didn't even know existed, and somehow costs more than an average home in some places. And then this thought hits you. How is that person affording this? Because here's the weird part. A lot of the time, they're not making more money than you. In fact, they might even be making less. So what's really going on here? How are everyday people driving around in $60,000, $70,000, even $80,000 vehicles without being rich? Let me introduce myself real quick. I'm someone who spends way too much time thinking about money, habits, and the decisions people make, especially the ones that look good on the outside but don't always make sense underneath. And today, we're going to break down one of the biggest financial illusions of modern life, because this isn't just about cars. It's about a system that makes expensive things feel affordable, even when they're not. Let's start with something simple. How much are people actually paying? Because once you see the numbers, everything starts to make a lot more sense and a lot less sense at the same time. Right now, the average monthly payment for a new car has climbed to around $700. And that's not for luxury brands. That's just normal. Now, if you look at trucks and SUVs, which a lot of people prefer, those payments often jump to $900, $1,000, even $1,200 a month. Think about that for a second. That's not a one-time purchase. That's every single month for years. Now, you might be thinking, okay, maybe people are just earning more money now. That would make sense if it were true. But income hasn't grown nearly fast enough to justify these kinds of payments. So if it's not higher income, what's making this possible? The answer is actually pretty simple, but also a little dangerous. It comes down to how car loans have changed. Years ago, most people financed cars over 3 or 4 years. Today, 6, 7, even 8-year loans are completely normal. Some lenders are even stretching it to 10 years. And here's why that matters. When you spread a large price over a longer period, the monthly payment drops. So suddenly, a vehicle that would have cost $1,400 now looks like $900. And psychologically, $900 feels doable. That's the number people focus on, not the total cost. But here's the catch. Lower monthly payment doesn't mean cheaper. It usually means the opposite. Because the longer the loan, the more you pay overall. Thousands, sometimes tens of thousands extra just for stretching it out. And it gets even worse. Cars lose value quickly. So while you're making payments for 7 or 8 years, the car itself is dropping in value the entire time. At some point, you end up in a situation where you owe more than the car is worth. This is called negative equity. And once you're in it, getting out becomes really difficult. But that's only one piece of the puzzle. There's another trick that makes everything feel even more affordable than it really is, and that's promotional financing. You've probably seen it before. 0% interest. Sounds amazing, right? Like free money. But in reality, it's not that simple. Because when you take 0% financing, you're usually paying full price for the car. No discounts, no negotiation advantage. So, one way or another, you're still paying, just in a different form. And for many buyers, they don't even qualify for those deals anyway. So they end up with longer loans and higher interest rates, which quietly increases the real cost even more. Now here's where things start to snowball. A lot of people don't keep their cars for the full loan period. After a few years, they want something new. But there's a problem. They still owe money on the current car, sometimes more than it's worth. So what do? They roll that leftover debt into a brand new loan. Now they're not just paying for one car, they're paying for the old one and the new one at the same time without even realizing it. And this cycle can repeat over and over again. Each time the numbers get bigger, the payments get heavier, and the escape gets harder. At this point, it's not really about affording the car anymore. It's about keeping up with the payment. And here's where things take a turn most people don't see coming. Because once that monthly payment becomes part of your life, everything else starts to shift around it. People don't just fit the car into their budget, they rebuild their entire lifestyle to support it. I've seen people downgrade their apartments just to afford a vehicle, cut back on food, skip vacations, delay important life decisions, all so they can keep driving something that looks impressive from the outside. And sometimes it goes even further. Some people take on extra work not to build wealth, but just to keep up with their car. Driving for rideshare, delivering food, working weekends, all to pay for the same vehicle they're using to earn that money. It sounds productive, but when you step back, it's a loop. The car isn't giving them freedom, it's quietly taking it away. Others turn to credit cards to cover everything else: gas, maintenance, insurance, anything to free up cash for that one fixed payment, which means now they're stacking high-interest debt on top of an already expensive loan. And then there are people who go even deeper, taking personal loans, borrowing against their savings, even tapping into long-term investments, all to make the numbers work today, but at a serious cost to their future. Because here's the reality most people never calculate. A car isn't just the monthly payment, that's just the beginning. You've got insurance, which gets more expensive the higher the car's value. You've got maintenance, and modern vehicles aren't cheap to fix. You've got fuel, especially if you're driving something big and inefficient. When you add it all up, that $800 monthly payment can easily turn into $1,200 or more in real monthly cost. Now, let's zoom out for a second. Imagine someone spends around $1,000 total on their vehicle over 7 years. That's over $80,000. And at the end of those 7 years, they're left with a car that's maybe worth $15,000, maybe less. So where did the rest of the money go? It didn't grow, it didn't build anything, it just disappeared. Now compare that to a different scenario. What if that same amount of money was invested instead? Month after month, year after year, that money could have turned into something real, something that grows, something that works for you instead of against you. But here's where things get tricky, because this isn't just a math problem, it's emotional. People don't just buy cars for transportation, they buy them for how they feel, for what it says about them, for the image, the status, the identity. And once that connection is there, it's hard to let go, even if the numbers don't make sense anymore. Because driving something cheaper doesn't feel like a smart decision. It feels like a step backwards, like losing something, even if it's actually the opposite. And that's exactly what the system is built on. Not logic, not long-term thinking, but emotion. Dealerships don't focus on total cost. They focus on monthly payment. They don't ask, can you afford this? They ask, can you handle this number each month? And as long as the answer is yes, the deal gets done. So when you see that shiny truck on the road, instead of wondering how they afford it, maybe ask a different question. What is it actually costing them? Because sometimes the most expensive things in life are the ones that look the most affordable.